Strategies for effective capital allocation in banking. Capital allocation is a critical function in banking that involves distributing funds among various financial products and services to optimize returns and manage risks. In this video, we will discuss key strategies for effective capital allocation in the banking industry. Risk-based approach. One of the most common strategies for capital allocation in banking is the risk-based approach. Banks assess the risk profile of their assets and liabilities to determine the amount of capital required to cover potential losses. By allocating capital based on risk, banks can ensure they have adequate cushion to absorb unexpected shocks. Basel III framework. Basel III is an international regulatory framework that sets standards for capital adequacy, stress testing, and market liquidity risk. Banks are required to maintain a minimum level of capital based on the risk they take. By adhering to Basel III guidelines, banks can enhance their capital allocation practices and improve overall financial stability. Capital stress testing. Capital stress testing is a proactive strategy used by banks to assess their capital adequacy in adverse economic scenarios. By simulating extreme conditions, banks can identify potential vulnerabilities and adjust their capital allocation strategies accordingly. This helps banks mitigate risks and maintain financial resilience during times of economic downturns. Asset-liability management, ALM. Asset-liability management is a key component of effective capital allocation in banking. Banks need to align their assets and liabilities to ensure a match in maturities, interest rates, and liquidity. By managing the balance between assets and liabilities, banks can optimize their capital allocation and minimize risks associated with mismatched positions. Capital efficiency. Capital efficiency is another important aspect of effective capital allocation in banking. Banks need to maximize the return on their capital while minimizing costs and risks. By deploying capital in areas that offer the highest potential returns, banks can enhance profitability and competitiveness in the market. Technology integration. In the digital age, technology plays a crucial role in capital allocation in banking. Advanced analytics, artificial intelligence, and machine learning can help banks optimize their capital allocation strategies, improve risk management practices, and enhance decision-making processes. By leveraging technology, banks can stay ahead of the curve and drive innovation in capital allocation. Effective capital allocation is essential for banks to sustain growth, manage risks, and maintain financial stability. By implementing these strategies and leveraging technology, banks can achieve optimal capital allocation practices and drive long-term success in the dynamic banking industry. Want to learn more? Claire Trithel on LinkedIn.